Good morning, ladies and gentlemen. Thank you for joining me, Centaur's update. We're going to update you on investment markets and how we're positioning our fund for the future. Just a quick overview on Centaur before I start. Centaur was founded in 2000 with three core principles to deliver investment excellence, and I'll show you how we've performed. I think we're delivering on that mandate with outstanding service. I hope most of you are happy with the service. We really pride ourselves on going the extra mile for our clients and also the utmost integrity. I think that goes without saying. I mentioned performance. I'm pleased to report the Centaur BCI Flexible Fund is #1 in its category over 5 and 10 years. So I think we are delivering on our first principle. We are a retail-only asset manager. We don't have institutional funds, and our funds are really focused in our 3 unit trusts. We reported 23% assets under management growth last year to 8 billion at the end of last year. Also, we launched our South African equity fund at the end of November, and that has over 300 million in funds currently. The launch was very successful. We did some roadshows, widespread support, and we are positive on the outlook for SA equity returns for a number of reasons, which I'll highlight later. Just looking at the long-term performance, someone used to say to me, "Don't give me pretty words, just show me how much money you made." And I think this is really the most important things when it comes to people. Can't live off promises. They really need to live off returns, and I think we've achieved this with over 18% returns over 23 years, handily outperforming our benchmark by 7% per annum. So our initial investors up over 51 times, and some of them are on this call. And what's also very important is consistent outperformance, which you'll see on some later slides. I think we're all very proud of the Springboks. Of 8 World Cups they've entered, they've won 50%. That's 4 and a 50% success rate. But what's most important is really the team spirit. The team comes from very diverse backgrounds, and there are different shapes and sizes in this team. But under Rassie Erasmus, there is an incredible team spirit. The team will give everything. And it's really this team spirit which I think uplifts the country and really produces the results, going just the extra mile compared to the other teams. And this is also very important for Centaur. So we've got a diverse team of 9 people. They've been here a long time. It's been a stable team, which is very important. They all know their responsibilities, all got different focus points. So I see myself really as the team leader, endowing my wisdom and really teaching the team to improve their game so they can take over the reins. Nick's been with us 3 years, but he's got over 8 years equity market experience. He manages the SA Equity Fund, and also he's a co-portfolio manager with me on the Balance Fund. So he's portfolio manager and also a very strong knowledge of markets. Lang lives overseas in Manchester. He looks at offshore equities, and we've had some incredible stock picks. That's really his primary focus, very close to the action, and that's, we think, is a unique selling point for Centaur. PJ was at Net Group for a number of years, 8 years total investment experience, a very strong equity analyst, and is managing the segregated portfolios. Mick joined Centaur 12 years ago. He was part of the original team in Johannesburg and really gone from strength to strength. He does our trading, but most importantly, he does our system development, and we've got a lot of systems in the background, and really that's his domain. So another key team member. On operations, very streamlined, and we're very on top of things under Kirsty. I'm pleased to report she's going to have a baby next month, so she's going to take a 4-month maternity leave, so we wish her the best. But we've got a capable team with Megan Morris and Kelly Sue Africa, who are really going to take up the reins, and we're fully comfortable that operations are going to run smoothly in her absence. Megan been with us 7 years, really dedicated to exceptional client service. Really lives and breathes it, and we get numerous compliments. Kelly Sue helps with finance and also client relations, been us with 2 years. And Chris really sums it up. He's head of marketing and also really these beautiful presentations, the quarterly reports, the marketing, also another key member of the team. So really a stable team, capable of managing growth. So we grew 23%. Really, we're managing very well because we've outsourced most of the back office functions, but we are looking for some new team members to bolster it and improve redundancy. Look, our investment philosophy, I think this is quite important. We call it dynamic value creation. So the first criteria, there's really 2 criteria, but the most important criteria is we're looking for companies that can at least return their cost of capital. So if you look in the diagram on the left, we're saying the cost of capital is growth of 14%. And you know, that is really a key aspect. We almost look at the cost of capital, say, of 14% to the current interest rate, which say on cash is 9%, and we compare them. So the company needs to earn its cost of capital. Secondly, we're looking for undervalued shares, that will earn its cost of capital. And if we can find an undervalued share that grows at 14%, let's say it's trading at 75% of fair value and moves up to fair value over 3 years, we arbitrage returns up to 25%, creating outperformance. And this is really conceptually what we're trying to do. But the way we do it, we've built it into some systematic models. And let me just give you some insight into our key model, which is TopSeg. And let me give you a story how it developed. I had the conception of dynamic value creation in the 90s when I was working at Liberty Asset Management. But the complication comes that markets are volatile and there's a lot of information. So in 98, you may remember the emerging market crisis of 98, where the market virtually halved in 6 weeks. I think the most volatile period in markets I've ever seen. I was part of a team of 4 managing 30 billion of Liberty Life's equity funds. And that was a very, very big portfolio at that stage. And we used to have a spreadsheet highlighting this value, and the total at the end was about 30 billion. When this emerging market crisis hit, the portfolio virtually halved in 6 weeks. And this was exceptionally traumatic. Imagine you're managing money, your adrenaline goes through the roof with this volatility, your cortisol goes through the roof, and you're essentially paralyzed. It's very difficult to make decisions. But also, you must bear in mind that you're reading reports that the world's coming to the end, the economy is going to collapse, and this has also a snowball effect on equity prices. So, you know, we've got prices moving, we've got news flow, we've got adrenaline, very, very difficult environment to make clear decision making. And I found that we need a way to ground ourselves to make clear decisions in times of stress. And this is really where my TopSeg stock picking model derived from. So if you look at the diagram, you know, if a company's fairly valued, let's say at 100, and its cost of capital is 13%, it'll grow at 13% per annum for the next 3 years, and the end price is 144. But under a crash scenario, these shares get undervalued. So let's say it moves to a crash price at 70% of its original price. So if it was 100, it moves down to 70. Over 3 years, things correct and moves back to fair value. Your return moves up from 13% to 27%. But the challenge is identifying this under times of stress. And what our TopSeg stock picking model does is collates all the analyst information and puts it into one model with an expected price, and we get expected returns. So as prices move, we can cherry pick the best opportunities, and this model proved itself in 2008, where we picked up some incredible opportunities in the 2008 financial crisis. You know, I think one that really stands out is we managed to pick up Coronation at 4.30. We eventually sold it out at over 100 Rand. That was our final tranche. That was a 25 bagger. And that really shows you just a couple judicious stock picks, how much a difference it can make to a portfolio. Just looking at our performance, I think 3 years is more important. 1 year there is a bit of volatility, but we did perform exceptionally over 1 year. Over 3 years, 14% outperforming our benchmark, but more importantly, over 5 years, we returned 13%. This is in our A class and number 1 in its category out of 49. Over 10 years, 11% outperforming the benchmark of 8% by 3% per annum, and similarly number 1 in its category too. Looking at our balanced fund, also strong returns, strong relative returns. Over 3 years matching its benchmark, but over 5 years outperforming a very difficult benchmark, number 10 out of 178 funds in that category. And over 10 years, the 4th best performing fund out of 86 funds in that category. Also outperforming the average by 3% over 10 years and our benchmark by 1.1%. So really meeting our mandate to deliver investment excellence. That's really what you get from Centaur. Looking at some of our biggest contributors and detractors, I'm not going to go into every one, but Dell, really an exceptional performer. It was off a low base, did come off in 2022, but up 111% in Rand, so benefited from a bit of Rand weakness. What happened there, exceptionally well managed, good business model, a market leader and gaining market share, but the real cherry on the top was it got a lot of AI hype, and that managed to give incredible returns and really make an exceptional difference to the funds. We have started to take some profits there, but it's still a large holding. Aspen, off a relatively low base, grew 52%. We like management strategy. They've built up a foundation for continued shareholder value creation, and we're backing that, so we're holding on. Exor, we've been in for many years, performed well, notwithstanding good performance, still looks very good value. Truworths we picked up. A difficult year for retail, but Truworths did exceptionally. That's done well. And Stellantis, which we've had for a number of years, a strong performer. We did sell out. Exor does have a large holding in Stellantis, and we thought the price was right to move out. On the detractors, mainly resource counters. So Sasol, African Rainbow Minerals, and Anglo American, all resource counters. The resource sector had a bad year in general. We were underweight, so we actually added relative value. To note is African Rainbow Minerals. We did buy aggressively near the lows, and that is one of our largest resource holdings. We do like that, and I'll give some of the rationale later. Just looking at the SA Equity Fund, it was successfully launched with over 300 million of seed capital. I think we've proven our ability. So if we back test, we've managed to deliver pre-fee alpha on SA equities of over 5% per annum over the last 6 years. And we are excited about the prospects. I think there is an improved backdrop to support South African equities, really with lower interest rates and a slightly better structural story for South Africa. And I'll go into that in a bit more detail just now. Just looking at our asset allocation, we are underweight relative to our benchmark. Our benchmark is 100% equities. At year end, we're only 80% of that, and we're going to use volatility, and we're tactically awaiting opportunities to move closer to our benchmark of 100%. Just some, we think in South Africa, some positive news are emerging. So the key one is really reduced load shedding. We've seen the severity of load shedding has decreased, and really the reason why is Kusile is back online. More generating units for both the Kuiberg nuclear and Kusile are going to come online over the next 18 months. So the severity of load shedding should decrease, and also some renewables are coming online. We've seen other things like the manganese rail expansion has been completed ahead of time. Transnet signed a private-public partnership for Durban Port, So there are some things happening. Another thing which is important, Wilson Bailey's has a record South African order book. So this shows you there is activity in gross fixed investment, particularly in roads, water, and renewable projects. So we think economic growth over the next 5 years will be better than the last 5 years. Growth over the last 5 years has only been about 0.5% per annum. We think it's going to pick up more towards the 1.5% range as we see it. And if management is more proactive, it can actually pick up more than that. We also select South African shares are attractively priced. Certain shares have dividend yields over 8%. And if we see growth pick up, we think there can be some re-rating and can yield very good returns. Just looking at inflation, food inflation spiked up, really two key reasons. The maize and wheat price moved up dramatically, which feeds through, but also load shedding increased costs dramatically. We've seen the white maize price drop off its peak over the last year, and also wheat is well off its peak. So those pressures are not pushing through to food inflation, and load shedding severity is much lower. So we are looking at a better outlook for food inflation. Just, I'm not going to go into details on this. I think just look at the bottom graph. When the line is below 0% in the red zone, that really indicates, this looks at the difference between the current the current interest rates and the forward-looking interest rates in 12 months. When it's red, it indicates interest rates are going to drop. And we've seen quite a persistent decline to the red zone. That indicates the market expects interest rates to drop. This is really led by the US, which towards mid-year can drop interest rates, and we expect interest rate cuts towards mid-year. And this is necessitating a shift to our investment strategy. Let me show you a reason why. Historically, the South African market has performed exceptionally well during times of loose monetary policy when interest rates come down. So during the loose phase, which we define as when interest rates fall 1.5% off the peak, the growth in the all shares being 24% per annum. That's the annual growth. During the tight phase, which is the inverse, the compound annual growth rate of equities has been 1%. So South Africa is very geared to the interest rate cycle, and the turn of the interest rate cycle means Centaur is getting more proactive, deploying some of our excess cash into equities. So we're changing gear, starting to buy equities, really led by this signal. Just looking at the rand, a lot of you will ask what's happening with the rand. We've derived a purchasing power parity model, which explains the rand pretty well over 30 years. And you can see until about 2013, the rand's central point was around purchasing power parity. In 2013 and subsequently, South Africa got downgraded, and then the rand traded at a permanent discount. This also coincides with the Zuma era. We think this de-rating is permanent, so we would say the rand should trade at about a 20% to its old fair value point. We pinned that at about 1765 at the moment. So that's the central point. So the rand is slightly undervalued despite this political discount. And we would look to move money back to South Africa to take advantage of this. Bear in mind, 1765 is the central point, so the rand could actually move, get overvalued relative to this, and possibly even move below 17. Just looking at US, so we've looked at the yield curve. This is when the yield curve gets inverted, when it goes negative. So that's the difference between the 2 years higher than the 10-year. And we've looked at returns. This does suppress returns, but often the yield curve inversion takes a long time to manifest. This cycle is not unusual. We saw an initial dip in the US market. It's recovered off a low base. but we think we must be cautious because history has said, listen, once interest rates start impacting and it affects equity return. So in 2005, it took a very long time for the US market to start falling. But once that happened, it was quite dramatic. So we are cautious on the US market, really because of the interest rate cycle, the economic cycle. And we see more downside risks to US equities than upside. Our investment strategy, just summing up what I've really highlighted. Currently, we defensively positioned around 10% below benchmark, but we see the imminent decline in the South African repo rate, and that's necessitating us to buy equity. So we're locking in some of the great value available, and we're increasing equity content, South African equity content, and also we're locking in some high fixed income yields available on government bonds to reduce the reinvestment risk. So we're taking on more risk, locking on the exceptional yields available, really looking to the future when interest rates start declining. Because the rand's weak, rand's undervalued, if the rand spikes out, we'll bring money back. We did this at about 19 in early December through futures overlays, and we'll continue to do that if we find good levels. We wary on offshore risks, I think more the S&P, the US market, but our stock picks are really based on individual stock picks, more so than a macro view. So as we see good opportunities, we will buy. If we think something's overvalued, we'll sell offshore. Offshore cash yielding about 5%. It's a good risk hedge and really gives us liquidity for purchases. So just looking at the current asset allocation in the funds, fixed income is 30% in the flexible fund. Our benchmark's 20, and we're looking to increase, downweight the fixed income, so move it more towards benchmark, take on more risk by buying South African equities and bonds, and we're upweighting equities to at least the benchmark and probably higher over the next 9 months opportunistically. Similarly, on the balance fund, a very similar story. We're downweighting fixed income closer to benchmark. We're switching into South African equities and taking a little bit more, locking in the yields on bonds and buying South African equities. Just looking at some of the top holdings, really these are replicated across all 3 funds. Aspen, our largest, we're looking for returns between 15 and 20%. Really, this has been a very good dynamic value creation over many years, and it's led by super entrepreneur Stephen Sard. What we found is he's built up a foundation for the next phase of growth. So he's set up a global multinational pharma company, and he's kind of executing on a number of growth vectors. So over the last 6 months, a lot of news flows coming out. He's going to be the leading African vaccine maker that's really supported by aid agencies. So we see that as a very real opportunity, and that will start unwinding in the next 18 months. He's made a number of bolt-on acquisitions, both in South Africa and South America and China. And really, he's starting to insource some of the production, which will also improve margins. Exor, we're holding on to this. This is, despite being an exceptional performer, so it's a holding company. It's managed to outperform the world index, which is a tough benchmark, continually for the last decade, but it's trading at a 45% discount to some of the parts. And what we also like about this, they're doing very aggressive buybacks, so they're harvesting that discount to add extra value. Dell, we're starting to take profits. The expected returns have dropped, but we still think it's an exceptional company and going to gain market share and be a big winner in the AI revolution. African Rainbow Minerals, this is our top resource company. We like the diverse exposure. So iron ore is its biggest profit generator. That's a very profitable business line. And also they've got PGM exposure. This has been a difficult business, but they've got a very strong balance sheet. They're empowered and they're also proactive. So they're growing volumes over the medium term. ABSA, this really We think the return on equities going to be higher than it has been in the past. This validates a higher rating. We like its African exposure. So if you go to somewhere like Kenya, they're one of the market leaders in Kenya. So they've got some very strong franchises in Africa, and 30% of profits come from Africa. We think that is a growth area. And we think it's well placed to deliver strong returns. This is trading on a yield well over 8%, which we think is good value. Just concluding, that really concludes my presentation. I think our process is proving itself. There's really a lot happening in the back end with the systems and really the way we analyze companies, and it's really proving itself in consistent outperformance. The team is gelling exceptionally well, and we have very good business momentum. So great growth in assets, as I mentioned, 23%. We see some positive signs emerging in South Africa, and also the change in the interest rate cycle necessitates an increase in South African equity exposure. And we are excited about the medium-term outlook for South African returns. So on a bottom-up basis, looking at the bond yields and the equity yields, we think mid-teen returns are possible pre-fees over the next couple of years. But having said that, we're not resting on our laurels. We remain grounded, we remain vigilant to the risks, and really value our clients and look to deliver going ahead. Thank you very much. That concludes my presentation. I'll now answer any questions.
Thank you, Roger. I've got some pre-submitted questions here. Do you still see value in SA as there are only 287 companies listed?
I think I still see value in counters. I think where the limited amount of companies come through is the breadth and liquidity is a bit concerning, but I also think it's where we are in the cycle. So as I find we're kind of in a bear market in South Africa, liquidity dries up in bear markets. If things recover, I think we could see some new listings coming on board, and also a liquidity improve. But we see enough shares to buy in South Africa. We've only got about 4 or 5 billion of South African equity exposure. The rest is in fixed interest and offshore. So we still see opportunities.
Your top contributors were most international shares and your detractors were local. Why do you hold so many local assets?
Can you please speak a bit louder? I just can't.
Your top contributors were mostly international shares and your detractors were local. Why do you hold so many local assets?
Our local performance was actually quite strong. So when we look across the board, I think I haven't done the attribution, but I think it was well over 15%, which is still happy. We're still happy with. Also bear in mind those are cyclical. So African Rainbow Minerals the previous year was a strong performer. Last year was not so good. And we think looking in the future they can deliver good returns. Also, we look to match our investors. If they're South African-based investors, we think they should have most of their assets in South Africa, because if the rand strengthens, they could be out of pocket quite badly.
What is your view on China's influence over South Africa? For instance, the weak economic and stock market outlook for China has been hammering South Africa, as well as we see that the JSE is down 3.8%, a lot because of China.
Yeah, I think China is very important because our largest company, Naspers and Process, are related to China. But having said that, China, not all the indicators are really bad. The growth, they're looking for growth this year of 5%. So it's not actually declining. It's still big. I think really South Africa's issue is more own goals rather than China. I don't think China is a negative. And, I think, the South African government has to do more to get growth going and promote capitalism. And they've also put a lot of structural impediments. So really, I wouldn't really worry about China. I think South Africa has to help itself. And that's possibly why our economic growth is not what it is.
What did you do differently to your peer group as far as research, stock selection, buy and sell valuations are concerned?
So we do have some systems. I did highlight the top six stock picking models, so that allows us to cherry pick the best ideas and ground us. But also, I think the way we look at models, at companies, we do our own analysis. We try see management and really have our own investment thesis, and really having very strong analysis. And we're on top of things at all times of the companies we own. I think that allows us to be very responsive, make very quick decisions, but informed decisions, and really control our portfolios and make calculated risks when the risk reward is at its most favorable.
What is your view on the biggest downside risks to impact SA macro and global macro, and how are these addressed in the fund?
The biggest downside risks is probably a world recession. So we see commodity prices fall off. Also interest rates are exceptionally high. So if interest rates stay longer overseas, I think that is a risk. I think we are looking for low interest rates to boost the economy. So I think, obviously a US financial crisis, there have been some excesses in US property and private equity. So that is a risk, contagion risk from offshore and risk aversion. So I'd say those are the biggest risks.
What will happen to the rand if the ANC and the EFF go into a coalition in the 2024 government election?
I think that would be negative. The rand, as I mentioned, is trading at about our fair value is 20%. I think the fair value, the market will ascribe an increased discount on the rand, so maybe a 30% discount to fair value. So fair value would move up to maybe 1940. So we could see possibly a 5%, 7% weakness in the rand over the medium term.
Do you think we'll have a global recession in 2024?
I don't think a global recession. I think the US is vulnerable because interest rates take a couple years to bite, and there's been exceptional fiscal stimulus in the US. So if that stops, the high interest rates start biting and the fiscal stimulus in the US stops, there is downside to the US. But I don't think a global recession. I don't think every economy is synchronized. So, for example, Germany was in recession this year. We think Europe could recover. India is growing exceptionally strong at 8% and more of a factor. China's doing okay at 5%. But we could see quite a big economic slowdown this year.
What is your equity outlook for 2024? Will you shift more overweight global versus local? How do you go about avoiding value traps locally? There seem to be many mouse traps going into 2024. Is your buy list showing more global or local opportunities?
Yeah, I think, local is very dependent on the pricing. So, in say September, we saw a lot of buys. The market recovered strongly in the final quarter, and we didn't think value was as good in South Africa. So, but there is volatility. So we look to buy things on weakness. It all depends on the interest rate cycle. That will be the catalyst. So over the next year, it depends on how the interest rate cycle plays out. This year could be a little bit slow, to be honest. But I think over a 3-year time horizon, things are looking much better. So I'm more positive on the medium term, let's say 3 years, rather than trying to predict the next 12 months. So as I said, over a 3-year time horizon, I think mid-teen returns are possible for really on a bottom-up basis. So some of our larger equity holdings, we're getting internal rates of return of over 20% with quite tight assumptions. And bonds, you can buy bonds on 11% yields. If there's some re-rating, you can get all-in returns of 14%. So that's really driving a more bullish view.
Are you planning to launch an offshore fund in the future?
We have been looking at offshore. So what we do have is we have segregated portfolios. We're fine-tuning our investment process. So we've been doing this a number of years. And we've also got a systematic approach, which is doing exceptionally, which has been outperforming the market. So we're going to look to combine our stock picking with a systematic approach to develop a fund. We still need to fine tune that, but probably within the next 2 years, we will launch an offshore fund.
Where are you seeing value in the small and mid cap space? Are you able to get in and out of these companies with your current fund size?
I think it is difficult. So really it is across a broad range. Like, for example, we bought Altron below 8, now it's 10, so it's up 25%. We bought Curo in the balance fund. So there have been some great opportunities, and those have all performed exceptionally well. Marafa we've had for a number of years, that performed strongly last year and still looks cheap. So there are some really cheap stocks in the small cap space. Wilson Bailey is another one which has started to perform, and these are very robust companies. A lot of them have operating profits close to R1 billion. They're not small companies, but liquidity is an issue. So what we do is we take smaller position size and we look at the liquidity risk. We're also trying to look for businesses that have a very long range run in profits, that we're not looking to get in 1 year out the next. We're looking to hold them 3 years, maybe 5 years, maybe even longer than that. Get a very long run of returns.
And do you still want to be invested in Aspen?
Pardon?
Do you still want to be invested in Aspen?
Yeah, Aspen, we like the strategy. So we've seen management build up a foundation globally. And really the strategy now is to load that foundation to load it up. And really, for example, there's a distribution network through South America. By adding, new product lines onto this, your profitability improves dramatically, and this is really what management is doing. So we really like the strategy, and we're very positive on some of the actions that have happened in the last 9 months. So really the execution of the strategy, I think the profits and the growth will manifest over the next 3 to 5 years. So we're happy to hold on to that.
Thank you. That's the end of questions, Roger. Thank you very much.
Thank you very much. Thanks everyone for your time.